when do we know? Okay. At what point in time, is the Fed's job over? When can they back away? When can they step off that accelerator on interest rates, which has impacted home buying? It's impacted consumer purchases. It impacts how companies think about investing in their businesses. As the cost of investing in people, products, and projects rise, you start to see them pull back. That balance of how aggressive does the Fed get to fight inflation versus the impact it has on the economy is front and center from an economic and a market focus. So what I want to do, give me 1 second. I want to get my pen set up. We've got the pen. Okay, you should be able to see the scribbles. For this question of where's the finish line, here's what I want to do tonight. I want to look at this from a few different angles. I want to start and talk about where does the Fed think the finish line is? Okay, what are they watching? What have they been watching as they've been trying to figure this out for not just the last 12 months, but this was a discussion. They hadn't started raising rates yet, but certainly on their minds in 2021. Then we're going to talk about where I have some differences of opinion between what the Fed has been targeting, what they've been looking at, and where I think some of those inflation pressures are coming from. And then we're going to wrap things up by talking about the market implications. Well, what does that mean for companies? What does that mean for investors as we move through 2023? We progress from the COVID issues that we had over the last 2.5 years, as we think about the future. And then at the end, we will jump into Q&A. Now, this question of where is the finish line, I'd love to look to the Fed. With them being the central interest rate setting body, you'd love to go to the Fed and say, hey, where do you think things are going? And have them provide you with a pretty good gauge, an estimate on what they expect to do over the next 6, 12, 18 months. The Fed wants to have credibility. They want to be a signal to investors in terms of what they should expect. However, right, the job they've had has been very difficult. And if we look back in time and we evaluate whether or not their projections on what they would need to do, where they would go, were realized after the fact, we will see there's been some significant moves. This chart, this first one I'm looking at, is going back to December of 2021. Okay, we're going back not to a month ago, December 2022. We're going back a year and a month. And the reason I want to start here, last year was obviously the year where the Fed started this rate hike process, started to really fight inflation. So where did they think they were going to go at this point in time? December 2021, looking at the year ahead, they said, you know what, we are probably going to have to raise interest rates. We're going to have to move off of zero, which is where we had stood since 2020. And they said, we're going to probably have to raise rates by about 0.75%. Okay, 0.75%. That was their general estimate on the magnitude of rate hikes that we would see over the entirety of 2022. And they said, look, we're probably going to have to continue that process into 2023, potentially into 2024. This is that time period, but it was going to be gradual rate hikes. I find it interesting. You look at the chart that they've got here, the very top of the chart, the highest range that they were considering at this time, a range they didn't think they would hit, was 4%. And we'll come back to why that's important in just a second, right? But the Fed was fairly confident that they were not going to have to do a lot in order to get inflation down. Now, to me, this is a bit ironic because when we stood here at this point in time, in December of 2021, at the exact same meeting where the Fed put out these projections, they were being asked about their views from December of 2020. They said, hey, back in December 2020, you told us that jobs were going to be a central focus to getting inflation down. The jobs that were lost during the shutdown, the shelter in place, as they came back, that would ease supply chains. And ultimately, you had projected that inflation would come down to 1.7%. That was where they expected to be with inflation in December of 2021, the exact meeting where they are putting out these projections for the year ahead. Where was inflation at this point? Well, it wasn't at 1.7%. It was at 7.0%. So, okay, I'm going to give them a little credit. They got that there was going to be a 7 there somewhere in the final number. They got one of the numbers correct, but they were notably off. And that was one of the things that triggered them to say we need to start moving. Okay, 0.75% I did not view as an aggressive move. There was a lot of commentators that said, hey, you're going to need to be a bit more aggressive than that to get this 7% inflation in check. And then we get into 2022 and we have Russia-Ukraine. We have the escalation, which impacts energy. It impacts food. We're seeing it show up across a number of areas within the supply chain. And I remember exactly where I was when I got the news that Russia had invaded. I was sitting in my family room in my home just outside Chicago, not too far from where many of you are. And I had my two kids upstairs. If you remember, the news that Russia had invaded came in at night here in the United States. And all I could think about was these families. Here I am, I've got my two kids asleep upstairs. My wife is laying down, and I'm thinking there's all these families over in Ukraine that want absolutely nothing to do with this conflict. And now they're stuck in the middle of it. And the next day I have to go into the office. We've got this humanitarian issue, this crisis, and we have to stop and think, what does this mean from an economic and a market standpoint? And from a market standpoint, people kind of looked and said, well, unless this escalates, unless Russia invades Poland and starts World War III, an unlikely scenario, we don't do a lot of trading. US companies don't have significant representation in Russia, in Ukraine. However, from an economic standpoint, we knew that energy is a major export from Russia, and that Europe in particular was going to be a bit vulnerable. This would raise costs, not just in Europe, but because we live in a global world, this was going to put inflationary pressures higher across the board. The Fed reacts. They say, okay, you know what? 3 rate hikes is probably not going to be appropriate. The next meeting they had, which is in March of that year, they said it's not going to be 3, it's going to be 7. Okay, we're going to have to move up to about 1.75% on the federal funds rate. Once they got there, inflation pressures were still building. There were still issues. They moved from 7 to 11. They moved from 11 ultimately to saying, look, it's going to be 17. Oh, that's a terrible 17. 17, the equivalent of 17 rate hikes. We went from 3, almost no movement, to exceeding the top of this band, going beyond the 4% that they had thought was kind of an absolute cap on where rates would move, not just in 2022, but over the coming years. So here's where we stood at the end of last year. Inflation was above 4%. Okay. And as they looked out to this year, they said, hey, we still have some work to do. Inflation is still stubbornly high. It looks like it's peaked. It looks like it's moderating, starting to come back down. However, it's not a sharp drop back down to the 2.5%, which they are targeting. It's been a more gradual decline. They said, look, as long as this is in place, we need to continue acting. The Fed has the 1970s in mind. There are really 2 periods of time that the Fed looks at as kind of critical junctures in their history, times where they feel like maybe they got policy wrong, and critical learning to take away and implement if those types of scenarios had come again. One of those situations was the Great Depression. Okay, they look back and there was policy things that they look back and say, hey, we messed this up in the Great Depression. It is influenced from that point forward how they thought about interest rates, how they thought about the management of banks. We saw the introduction of things like FDIC insurance. There was a massive shift after that. The second time period that they've been so critically focused on is the 1970s. The 1970s, where we saw double-digit inflation. We saw the Fed ultimately have to raise interest rates up to 15, 20%. You may remember those time periods. Okay, and so the current Federal Reserve, led by Jerome Powell, the chairman, came into this year and they look back on that time period, and there were 2 leaders. The first half of the 1970s, you had Arthur Burns. He was the chairman of the Fed. And if you have studied this in history, if you went through that time period, inflation was rising. In the 1970s, the Federal Reserve began to act. They raised interest rates. And the idea here being you make it more expensive to borrow and buy a house, more expensive to borrow and buy a car, more expensive to borrow and invest in a business. You will see a slowdown in that activity. You will see a moderation in the economy, and that will help to get inflation in check. Now, this starts to work. They start to raise interest rates. The inflationary pressures start to ease, but as you slow activity, you start to see companies say, okay, well, we're not making those investments. We don't have quite the same demand we did before. You start to see them let go of workers. You start to see the unemployment rate rise. You start to see economic output slow as we pull back on investment. And when those economic pain points were felt, Arthur Burns, the Federal Reserve, prioritized the economic pain, and they reacted. They pulled back on interest rates. They dropped them lower once again. And at that point in time, what happened is that the economic growth kind of helped. It started to progress but inflation reaccelerated. And we learned a lesson. The next person to come in, Paul Volcker, came in and he was tasked. They said, look, we started to fight inflation. We stepped back too soon. We need this. We need this managed. Inflation is issue number one. And this is critical. We need to get inflation in check in order to have a stable grounding, a stable footing off which the US economy can grow into the future. So Paul Volcker, he prioritizes inflation. He says, look, we're going to have to accept pain in order to get this. We're going to have to take our economic medicine, and they raise interest rates. It does cause economic pain, but they hold. The economic pain is there, and there's calls for them to start cutting interest rates. He says, I won't until inflation is checked. And ultimately, they got the job done. Inflation comes back down. Over the next 4 or 5 decades, we see some significant progress, this continual gradual decline, essentially, in inflation. And Volcker goes down in the economic history books as a hero. And Paul Volcker, this is who Jerome Powell would like to emulate. He wants to be Paul Volcker 2.0. They know the risks of stopping too soon. And while we will likely see this year some pain start to come on the economic front, we're seeing already some moderation with employment, some moderation coming in terms of business investment on the manufacturing side, on the service sector side. They said, look, we need to keep moving. Our base case is that we're going to have 3 rate hikes this year. Okay, you can see that here on the Fed's dot plots. They're expecting to do about 75 basis points, 0.75%, 0.75% in terms of rate hikes this year. But when you turn on the TV, and the markets in particular, if you've been watching them to start this year, they are watching every data point from an economic perspective that gets released. And sometimes good news is good news. Sometimes good news is bad news, and bad news is good news, and then bad news is bad news. They're trying to figure out what will influence the Fed to either start the pause process or the rate cut process earlier, to start easing interest rates, or something that gives them a sign that their job is going to be even harder than they anticipated. And most of the signs this year, we are seeing a moderation in growth, but we're not seeing a collapse. People are saying, hey, look, this is kind of a Goldilocks scenario. It's not too hot. It's not too cold. Maybe we're just going to see this slowdown. We won't have recession. Fed, go ahead and stop your process. And the Fed said, that's not the camp that we're in. Our base case is that we're going to do 0.75% of rate hikes this year, but 7 of the members expect that number to be higher, and just 2 are on the lower edge. The markets are fighting the Fed on this. And we have a Fed meeting next week. Next week, Wednesday, the Fed will make their next announcement. They're not going to be providing new forecasts. They do that every other meeting. And since we had one in December, we won't get another look until we get out into March. But I do expect that Chair Powell and the other members are going to reiterate, look, 2023 is the year where we make sure the job gets completed. So the Fed says 3 rate hikes. Maybe 3 rate hikes of 25 basis points, or maybe they do one of them at 0.5% and then 1.25%, but that's where they think they need to get to. And then they can stop. Then they're going to watch and see how this reverberates throughout the economy. And at that point, their expectation is the next move will be a cut. They're going to hold there until inflation comes down to that target area. Then they can start easing. But I don't believe that's going to happen until the end of this year, into early 2024. Now, they're trying to figure out and trying to gauge. This is, I will tell you, an incredibly difficult thing to do. They're trying to kind of guess, when is that point where inflation has moved far enough, the economic metrics have moved far enough that they can have the confidence that inflation is sustainably down. And for that, they have been discussing, they've been focused on what's happening on the job side of the economy. This is where they said, look, the jobs are what needs to come back. If we get that solved, if we get the job issue fixed, after what happened in 2020, you look at March and April of 2020, in that 2-month time frame, we lost about 22 million jobs. Okay, 22 million jobs. We more than doubled the job losses of the financial crisis itself, a painful recession, and that took place over 2 years. This was swift, this was sharp. And we saw this. If you turn on the TV in 2020 and 2021, You probably saw the coverage. You heard about the port of Long Beach, where there was 111 ships waiting offshore. There was a lack of truck drivers. There was a lack of transportation staff. There was a lack of warehouse workers. As we started to see some of the tides turn, as we got further into 2020 and we had better data. We had testing capacity. We learned more about what we could and couldn't do around COVID. We learned who was vulnerable. We learned better treatment methods. As we progressed through 2020, activity responded, consumers responded. We'll look at quite how much in just 1 minute. But the Fed said, look, this is the progress we need to see. And they had high confidence that if we got back to the employment levels that we had pre-COVID, that everything would kind of return back to normal. Inflation would go away as an issue. So 2021, they said, look, okay, in 2021, get the jobs back, supply chains will ease, inflation will come down to 1.7%. That year, 2021, was a record year for US job gains. We have never in the history of this country added more jobs than we did in 2021. Now, we were coming off of a low point. It's not that we had gotten back. We weren't adding net new jobs, but we were returning people to work. At the end of the year, inflation's at 7%. They said, well, we've made progress. We're just not quite there yet. In 2022, the jobs will come back. The supply chain will ease. Their forecast for 2022 was that inflation would come in at 2.7%. We go through the year. We add in total about 4.5 million jobs. 4.5 million jobs. If you compare that, let's say, to 2019, let's go back pre-COVID. How do we tell if that's a good number, a poor number, an average number? Well, in normal times, the US economy adds about 150, 200,000 jobs per month. So you're looking at 2 to 2.5 million jobs added. Last year, we continued to grow at a well above trend pace. And in fact, last year, we surpassed pre-COVID highs. We have more people working today than ever before. We lost 22 million jobs. We bought 23.2 million back. We were up a net 1.2 million workers. So here we stand. And once again, the Fed said, look, the jobs, which we needed to see come back, they've come back. Inflation should be moving lower. It should be lower than it is today. This should be resolving itself. Unfortunately, it's showing itself to be incredibly sticky. And that has made determining where that stop point is. When you're trying to follow the roadmap and you take the turn, but it's not leading you to where you thought it would, it's making it hard to navigate from that point forward. What I will say is, I think this was one side of the equation. When we're watching, as we watched through 2020, 2021, 2022, we looked at this and said, yes, jobs are a component. Jobs are a component, easing the ports, making things more available, bringing down shipping rates because we can now process goods quicker through the system. That is going to be one portion of the equation. But if you've ever taken a class in economics, you know that so much of the pricing, as we think about impacts, it's not just supply we focus on, it's supply and demand. Okay, supply and demand. We focus on both sides of this equation. The Fed was very focused on the supply side and said, well, look at what's happening with demand. This is retail sales. This is consumption, primarily goods, but there are some services here in the US economy. And what did we see in 2020? In 2020, that year where activity fell off a cliff for 2 months, we sat there March and April, a time period I don't think any of us will ever forget. And we were trying to figure out, can we go outside? Can we go to Starbucks? Is the grocery store going to be open? During that time period, we were navigating incredible uncertainty. And then we got our feet underneath us. And as we so often do, we started to respond. We started to come up with new ways. How do we interact? How do we get the goods and services we need? How do we help others in this environment? In the second half of 2020, activity surged. And in fact, by the end of that year, by the end of 2020, we were up and setting new highs on a spending standpoint. Now stop to take that in for a moment. We were spending at new highs at a time period where we had 10 million fewer workers, 10 million fewer people receiving paychecks on payrolls, getting sustained month after month, every other week, source of income coming in. From an economic perspective, that shouldn't happen. Okay, and so there was some perplexity. We continue moving on through 2021, and the activity continues to rise. We're seeing a pickup in goods. We're seeing a pickup in online purchases. That's what we did in 2020. We moved from the outside inside, the inside online. You couldn't go to the hardware store down at the corner. We had the hardware store come to us. And we continue to see this surge in activity. In 2021, by the time that year ended, we were still down about 3.5 million workers. But at that point in time, we were up and spending 20% above pre-COVID levels. And as economists, we had to look at this and say, how does that happen? How, with fewer workers, fewer paychecks coming in, with less compensation from wages and salaries, how can this sustain? I mean, what happened during this time period? You don't need an advanced economic degree to understand that if you give people money, they will spend it. And the US ran stimulus. That money came into the system, the checks, the PPP, the direct stimulus checks, the additional unemployment benefits that were meant to be a stabilizer. They were meant to help people get through 2020, 2021, that time period where businesses were shutting down. They were closed, not because they had bad products, not because they had bad service. They were closed for health and safety reasons, right? And so the government said, look, you can't be there. And we understand this is not your fault. So we're going to try to figure out ways to ease this process and get through. To a degree, it was economic morphine. It was a painkiller that helped ease the process as we went through difficulty, as we went through turbulence. However, that morphine, while it helped ease the pain, it wasn't fixing the underlying issues. So when the checks stopped in 2021, we were still at a point where we needed to get our feet grounded. We still had companies that were missing, supply chain disruptions, relationships between businesses, both within the United States and internationally, that had run into friction or had seen kind of a break in their transactions during this time period. We still had work to do. And as we progress through 2020 and as we move into 2023, this is a key question. How long can we continue to move forward? We now have some of the jobs back, but we're spending well above the levels that we would expect to see over time. Now, before I progress and I talk about what I see happening with inflation, there's something I can't gloss over here. Think about this for a moment. I think it is truly incredible what happened in 2020. And yes, it was a difficult year. Going through COVID, nobody wants to see that happen. Nobody wants to go through it, but it was a reminder. Okay, a reminder. I was having a conversation with my wife's great-grandfather. He's 98 years old. We're having this conversation last year in 2022. It's his 98th birthday. I'm there with my wife, my 8-year-old daughter, my 5-year-old son, and I'm watching my daughter and Grandpa Doll having a conversation. And I asked Grandpa Doll, I said, Grandpa, how are you doing through all this? This has got to be a turbulent period for you. He said, you know what, Andrew? I'm not that worried. And this shocked. I mean, he's 98 years old. He's got health issues, and I'm watching. And I'm like, look, you're watching the markets go to turmoil. You turn on the TV, you turn on the radio, you open up the newspaper. There's constantly been something to worry about. And he said, you know what, Andrew, we've been through this before. Maybe not a pandemic, but he said, look, I'm 98 years old. I fought in World War II. I grew up in the Great Depression. I saw the Korean War. I saw the Vietnam War. I saw civil unrest. I went through the double-digit inflation of the 1970s. I saw the global changes in the 1990s. I went through the dot-com bubble. I went through 9/11. I went through the financial crisis. He said, you know what? We're going to move through this one. And he said, you know what I've learned is that we progress. And I started thinking about this. And I'm like, well, that's good perspective, right? We do progress over time. It's not always easy. It's not always comfortable, but sometimes times of adversity push us to grow even faster. And as I'm thinking about this, my daughter starts asking him questions. She starts talking to him. She's like, Grandpa Doll, hey, what was your favorite Disney show growing up? And Grandpa Doll, he just kind of chuckles and he's like, well, sweetheart, we didn't have Disney on TV when I was growing. In fact, we didn't have a television when I was little. And he's telling her about the radio shows that he used to listen to with his brother. And my daughter is really confused by this. Like, what is this world with no Netflix? What is this world without Disney Plus? She's never seen a VHS tape, right? She's never really seen a DVD. Her world looks so incredibly different from his. And I start thinking about all these changes that have happened, what his life looked like 90 years earlier versus the world my daughter lives in today. And I realized, we don't have to go back that far. You don't have to go back 90 years to be amazed by how far we've progressed. Okay, think back to this. What if COVID had happened 20 years earlier? What if COVID had happened back here around the year 2000? Do you guys remember Y2K? Do you remember how worried we were about Y2K? I remember exactly where I was on 12/31/99. I was in Naperville, Illinois, about 26 miles straight west of downtown Chicago, and we are watching a ball drop, our own mini version of the ball drop. And as it's close to zero, there is a tension in the air. People are looking around. Are the streetlights going to go out? Is my VCR going to start blinking midnight and that tape I picked up from Blockbuster all of a sudden is not going to work? Right? And it hits midnight and nothing happens. Right? And we realize, okay, maybe it wasn't as big of an issue as we thought. We enjoy that midnight. We go on with our days. I'm thinking about this 22 years later, and a couple things hit me. One, it hits me, and I'm thinking, wait a second. Naperville, Illinois is in the central time zone. How in the world did we not know that Y2K was going to be a non-issue? I mean, it had happened an hour earlier on the East Coast. Today, if that something like that were to happen, we would have the alerts on our phones at 11:01 Central Time. You'd have 4 different alerts from 4 different news agencies letting you know, hey, don't stress about this. The system was able to handle it. But back then, we didn't have the cell phones. Back then, we didn't have the iPads. Back then, our capacity to communicate with friends, with family members, okay, our ability to get information about what's happening in the world around us, it looked very different. And then I started thinking about, okay, well, my wife is a teacher. She's a 4th grade teacher. During COVID, her classroom moved inside and online. They moved to Google Classroom. Her 4th grade class starts meeting virtually. It would have been incredibly difficult to do anything like that 20 years earlier. We simply didn't have the technology. I think about what happens. We moved into a new house in 2020. We moved in March of 2020. Okay. We had started this process in 2019. I had no idea that COVID was going to turn into what it turned into. We move in and everything shuts down. But we need to replace light fixtures. And I've got to replace a plumbing part. We had an issue with one of the toilets right after we moved in. Okay. And I couldn't go to the hardware store down at the corner. Their doors were closed. So where did I go? Well, I went to Amazon. What was Amazon 20 years earlier? Amazon, which came into COVID, it was the biggest country in the world. Jeff Bezos went from being the bald bookseller to the richest man in the world, literally shooting himself off into space. And 20 years earlier, they were a bookseller just getting into other goods. There was no Prime. There was no 2-day shipping, no 1-day shipping, no same-day shipping. The progress that we saw over the next 20 years that allowed us to do what we did during COVID, those companies were not doing it because they said, hey, you know what? We've got that pandemic coming around the corner. We better be prepared for it. No, nobody knew that was going to happen. It's because we live in an incredible place. We live in a place with private property rights, with rule of law, with a democratic system. It is, I think, the best place in the world to grow a business. And we go through turbulence. We went through the financial crisis. We went through the dot-com bubble. We went through COVID, and then we progress. And this is why we invest over time. Don't lose sight of this. We sometimes take for granted the progress that happens, but we get real caught up when we see the downside occur. We get caught up because it's jarring, because it's so different. And because progress happens day after day and week after week, month after month, we lose sight of just how miraculously the world around us has changed, what's become available for ourselves, for our children, for our grandchildren, for future generations. Okay, don't lose sight of that. There are going to be things that emerged from 2020, from 2021. There are going to be new ways of bringing medicine. Okay, there are going to be new ways of developing vaccines, new ways of communicating. Companies have kind of had to reinforce, they had to reevaluate. There are going to be progressions. We've seen some of them occur already. They're going to reverberate into the future. Don't lose sight of the progress. Now, in the short term, in addition to the fact that, we saw this escalation in terms of purchasing activity that will moderate, the injection of money that came into the system had a direct impact flowing through to inflation. It increased demand and supply was restricted. With more demand, less supply, prices were going to rise. And now people are looking and saying, okay, they're starting to come back into balance. We're starting to see some moderation. The good side of the economy is slowing back down. It's coming back down to earth. Services are getting back. We're back on the flights. We're back at the car rental centers. We're back at the restaurants. We're back in the hotels. What's going to happen with inflation? Well, we look at inflation, and typically we look at what's called core inflation. This takes out food and energy. Why? Because food and energy are normally very volatile. They add some noise to the data. They are considered, but when we're looking at the trend path of spending for the average consumer, we pull those out and we look at everything else. This core number, which the Fed focuses on, was driven very heavily in the early stages by what was happening to goods. You remember the freight rates were rising, lumber prices soared. I was having a conversation with someone who owned an AC, a commercial HVAC company in Indiana. And during this time period, we were talking, I said, how is business? And he said, well, we're having a heck of a time getting merchandise. We're having a hard time getting parts. I shipped them over from China. If I go back to 2019, my average freight rate was about $2,000. And at this point, in late 2020, he said it was costing him about $24,000. It had gone up 12-fold. And he said, and it's the world we live in. I asked him, I said, is that just crushing your business? He said, well, it's not really crushing business. Everybody that calls me, nobody's asking how much things cost. Everybody's just asking if they can get it. And he said, we're going to be able to pass through some of these costs. It's just a matter of filling these shortages. But those types of events really impacted inflation numbers. It really pushed the CPI number higher. When it turned, people started to say, look, okay, this is the inflection point. Once this is behind us and metal prices, lumber prices, air conditioner prices, when they come back down, inflation's going to come with it. But here's what we're seeing. That transition in 2020 from the service side of the economy, which is so much outdoor, to the good side of the economy that came to us during COVID, that's reversing. And the service side, which is where we normally spend about 3 times as much money as the goods side, has now taken the lead. And goods inflation is continuing to accelerate. This is showing up in transportation. It's showing up in warehousing. It's showing up in airlines. You will see prices for things like used vehicles come back down, but there is another factor at play. And the Fed is looking at this and saying, we need to make sure before we loosen, before we stop, we need to make sure that these core forces behind inflation are in check. This is, to me, a sign that their job is not done. I do expect to see this turn, and I expect to see it turn this year. Why? Because of this number, M2. Now, don't fall asleep on me. Just stick with me for a moment. M2 is the money supply. It's the money in the hands of consumers and businesses. Okay, so when the M2 accelerated during COVID, when the PPP checks, right, when the stimulus checks came into the system and we put money in the hands of consumers and businesses, this number skyrocketed. Now, this chart is looking at the year-over-year percent change. Okay, so this space underneath the blue line during these time periods is money being added. We added money to the system in 2020 into 2021 in a way that we haven't in the last 60 years. Have we ever? Yes, we have at some points in history. If we were to go back even further, go back to, for example, the 1940s, and we look at the spending that occurred during World War II, during that time period, we saw a huge injection as we bought tanks and planes and munitions to fight the war for democracy. We have seen things like this before, and we dealt with them. We dealt with inflation, and we grew. So as we look through this time period, as we look at the after effects of what's taken place, this isn't unprecedented. It's not fully unprecedented. It's looked different, but there are echoes. So we look here, and what we find, and this is important, what's critical today is that the money supply has stopped growing. We've stopped adding money to the system. We've stopped adding inflationary pressures. In fact, this number, we got new data this afternoon. I haven't had a chance to put it in, but for the first time in 60 years, we've actually taken some money out. It's modestly negative, about 1% negative. But this is a critical piece with inflation. If nothing else, if we stop the growth, we at least know how much needs to be absorbed. How much inflation do we need to see in order to have taken in, processed everything that was done through all of that spending? Once it's been absorbed, inflation comes back down to normal. That's exactly what the Fed wants. Okay, but Well, it's a positive that this has stopped growing, and we now have a better grasp of how much inflation we need to see. What we ultimately went through was like a car accelerating up to 150 miles an hour and then slamming on the brakes. And as you're accelerating, right, the economy accelerated along with it, but the stomping on the brakes, stopping the growth in money. Think about what this means. If we see a reduction in the money available to businesses, available to individuals, you see a slowdown in investment. You see a slowdown in purchases. We have less spending capacity. What that brings with it is the dreaded R word, recession. But remember, not all recessions are the same. The recession we went through in 08, 09 was a debt crisis. This is not that. The recession that we went through in 2020 was a health crisis. This is not that. In the scheme of deep recessions, moderate recessions, shallow recessions, I do expect this is going to be on the shallower end, but that doesn't mean it's going to be fun. When you see the job loss numbers start to rise a little bit, it's uncomfortable, particularly for those people that are going through it. And the Fed has to look at it this year and say, hey, part of this, is we've made some decisions from a policy standpoint. We're dealing with some of those consequences, but what we're doing today is getting back to fundamentals. And that is critical. From an economic standpoint, we will progress. From an economic standpoint, this year, growth may turn negative. It may be a more difficult year, but we are going to emerge, and we're going to be stronger, and we're going to be smarter than ever before. And as we move 3 years, 5 years, 10 years into the future, we are going to invent, design, create incredible things for the next generation. It has not stopped the growth engine. We're just going through a difficult transition. Now, from a market perspective, and that's where I'll wrap up, what does this mean for the markets? And here's how I think about it. There are kind of two ways of looking at market movements. There's the side that's dictated by fundamentals. Are companies making more money? Are they investing in the business? Those things move markets forward over time. There's another component, and that's emotion. Emotion I can't control. Emotion I can't forecast. I can't tell you when people are going to feel good, when people are going to feel bad, when uncertainty is going to escalate anxiety and cause people to make decisions that the underlying data does not justify at all. But I do believe that emotion, which can move us over the short term, it moderates itself over time, and the data wins out. So what we do during times like this, where uncertainty remains elevated, is we focus on the numbers that progress us over time. The two core numbers being, what is the cost? The cost to invest in people, products, and projects. Is it restrictive? Is it slowing down that investment? And two, are we seeing movement in the earnings side? As shareholders, and that's what we are. If you buy into a company, you buy into a fund, you buy the S&P 500, you buy one of those indexes, you are at that point a partial owner in these companies. And what we care about is their cash flows. Are they making money? Are they passing that through to shareholders in dividends, in buybacks? So let's look quickly at those numbers. We'll wrap this up and we'll jump into Q&A. On the interest rate side, clearly we've seen an acceleration. 2 years ago, 3 years ago, we were dealing with interest rates, 10-year treasury rates of 0.5%. Think to yourself, when you bought your first home, could you have imagined a world where interest rates, 30-year mortgage rates were going to drop below 3%? Very few people could. This trajectory that we were on after that unbelievable double-digit inflation, if you told somebody in the 1970s, hey, 20, 30 years from now, inflation's going to be running under 2%, and they're going to have a hard time getting it above that, people would have laughed and thought you were crazy, but that's what happened. We moved to this time period, and in 2020, interest rates were low. In 2020, they started to move higher. 2022, we saw a massive movement. In fact, the Federal Reserve raised interest rates by the most that they have at essentially any point in their history. It was a dramatic year of change. And because we were coming off of such low interest rates, the coupon payments from existing bonds that you might have had on the books, they weren't enough to help cushion the impact of a rising rate environment. Last year, both equities and fixed income, the bond side of the equation, got hammered in a way that we have virtually never seen in history. The good news is that the bond math has now improved. what you can get, the compensation you get as a saver, as a lender to companies, as a lender to the US, your return is now at levels that you haven't seen in more than a decade. It does mean that for companies, it's more expensive. And you are seeing, as we mentioned with the M2 decline, a reduction in some of that activity. Okay, so from a markets standpoint, from a stock market standpoint, this is a bit of a headwind to market performance. So then we go over and we look at what's happening on the earnings side of the equation. What is happening in terms of company performance? If we go back and look at time, we can see things like the financial crisis, 5 years for earnings to come back and set a new high, and then we progressed. And then we went through the recovery, and we went through years like 2018 with the corporate tax cuts. 2018 earnings rose by about 15%. And what did the markets do in 2018? They fell. Why? Because in that point in time, emotions were high. In 2018, people were worried. What about the Fed is raising interest rates? What about US-China trade relations? What about the fact that we were discussing and dealing with a government shutdown? Those emotions overwhelmed for that period of time. When cooler heads prevailed and we look back at the data, we had 2019 where earnings barely moved and the markets boomed because they were reacting to what they should have done in 2018. The math won out over time. In COVID, earnings fell back to basically where they were pre-COVID. In 2021, they soared to new highs. We went from about $165 a share pre-COVID to $200 per share in 2021. We're getting the final data for 2022 right now. Companies right now are reporting Q4 data. I don't have a finalized number, but let me show you where the analysts expect we're going to end up with the 2022 numbers as they look out into 2023. And here's where we're at. Last year, it looks very likely that earnings rose for companies as a whole. People are often surprised when they hear that. They're like, wait a second, the market's plummeted. What do you mean that earnings rose? Yes, earnings rose, not as much as they were originally expected to when the markets thought that they were going to, Fed was going to raise interest rates by less than 1%. It started off expected to be closer to 220. It's moderating, it's coming back down. Okay, but they will, it looks like, end up higher. The key question here is in 2023. What we're seeing right now is people are starting to write this down. They realize that those difficulties, they realize with the Fed's job not done, that there is still work. And what we're seeing is that earnings are being revised lower. We're starting to see the S&P 500 estimates for earnings come down. We're seeing that some sectors are more hit than other sectors. These are part of the conversation that we have with the team. We start looking at, as we think about the portfolio and riding through some of this stormier weather, how do we do it? We look at the market as a whole. And what it shows us is that based on history, if we go back to 1955, look at every single quarter and ask what happened with this cost of investment, what happened with earnings, and how has the market responded? If we look back to history as a guide, it tells us that the markets today are fairly to slightly overvalued. That based on history, with these rising interest rates, earnings that are up, but really moderating, that this is a period of turbulence, that some adversity, volatility is to be expected. We will progress. Again, we will get past it. But during this time period, what we look at is how do we intentionally weather some of these storms? In this environment, how do we try to ride through some of that volatility? What I love is that the team that you have, right? We get to have these conversations on an ongoing basis. I love that they said, hey, can you come on tonight? Can our clients hear some of the conversations that we get to have? We're having this conversation on an ongoing basis as data comes out, as things progress, as new events unfold. But you know what you guys do? You travel through time together. You travel through time together. You have the conversations on not where you want to be in 3 months, though that may be some consideration. If you've got a cash flow need in 3 months and 6 months and a year, that's certainly, but they're looking and saying, where do you want to be in 5 years, in 10 years, in 15 years? What do you want the future to look like in terms of what you can provide to your children, to your grandchildren? And what we do is we step back and say, look, we can't predict the short term. I've not met anybody who can predict the markets. But it's not at the end of the day about timing the market. It's about time in the market. It's about the intentionality. It's about being a participant in the entrepreneurship, the innovation, the progress that we're making. Let me end on this. 2 weeks ago, I was with my family. We went on a cruise to kick off the year. I travel just about every single week. I spend about 130 nights a year in hotels. During the Christmas time, right after, we went on a family trip. And we went on a cruise from Miami to the Caribbean over to Mexico. Between the Caribbean and Mexico, we passed by Cuba. We passed 55 miles off the coast of Cuba, and the boat stops because someone has seen that sitting out there 55 miles off the coast is someone in the water. And so we send out a boat, and they pick somebody up that was sitting on a flotation device. And we find out it was a 29-year-old Cuban national who was trying to float to the United States. And they had built a boat out of a fishing vessel. It had sunk off the coast. And I'm watching this unfold. And I'm thinking, wow, what it's incredible, right? What they were trying to get to here in America, that they saw what the situation that they were in. They saw the opportunity that exists if they can make it here, what they were willing to risk in terms of life, limb. This is a 29-year-old with a single pouch around his neck, with a water bottle, trying to float about 100 miles to the Keys of Florida in order to get a new life. And it made me step back for a second and put things in perspective. And I'm watching this unfold, and I look inside, and there's my two kids, and I think, we're incredibly blessed to be where we are. There are difficulties. We're dealing with inflation. The fight's not over, but let's put it in perspective. Where we live, what we get to participate in, the progress we've watched throughout our lifetimes is absolutely incredible. Keep that in mind as we progress through this year. That's a lot of listening to an economist on any given day. So here, I'm going to stop talking. And what I'd love to do is pass it back to the team, and we can dive into any questions that you might have. So why don't we go ahead and jump into that?
All right, very good, Andrew. I'm not sure if you can see the chat bar. I'm going to ask a couple questions that are on there. And sure. I'm also going to ask all the participants if they do have a question, just to put it into the chat bar, and we'll get to those.
Okay.
The first question on there is, what happens to our savings if the politicians don't raise the debt ceiling?
Yeah, so the debt ceiling is something we've seen constant fights over, and I'll tell you, the debt ceiling debate to me is it's kind of exhausting. It's I do not expect that we're going to default on our debt. I do think, the Treasury's gone into extraordinary measures. They can do that for a period of time. We are quite honestly very poor projectors on what that means from an economic or even from a debt capacity. If you think back again to 2018, we went into shutdown. And if you remember, they shut down some of the parks, and they let some of the workers, they had them stay home. Now they get back pay when the work ultimately comes back. And if you had turned on CNBC during that time frame, they ran a little ticker in the bottom corner of the screen that said every day that the US government is shut down, it's subtracting X amount from GDP. And it went on day after day after day after day until we got the GDP report and we got the resolution. They raised the debt ceiling. And what we found out is that all those projections on the economic impact that it was going to have didn't hold true. Okay, they weren't even close. We tried, you try to estimate how consumers are going to react. You try to estimate, but this is an incredibly dynamic system. And I think most people realize there's going to be prognostication in Washington. Anytime you have that split between the House and the Senate, which the Senate right now is with the Democrats, the House is with the Republicans, they're going to butt heads. They're going to call each other names. They're going to fight over the debt ceiling. But when push really comes to shove, I do think we will see a resolution. I do not see the U.S. defaulting on its debt. I don't see a debt downgrade coming. I think that the U.S. Treasuries are still the safest bonds in the entire world. But there's going to be some theatrics before this is all said and done.
All right, very good. You make a forecast for the S&P 500 at year end?
Yeah, so we do put out forecasts, and again, we use this model that's up on the screen. This, I will note that the model we use is not a market timing model, but it's a market valuation model. And then we take in what's happening from a political standpoint. We take in what's happening from a consumer sentiment standpoint. Our target for this year for the S&P is 3,900. It's basically flat from where we started this year. Now, that said, the expectation is we're going to see most of the turbulence in the first half of the year. as companies really acknowledge that the higher interest rates, not just here domestically, but internationally, are impacting business, are impacting consumer demand. I think you will see some more of the pressure coming in the first half of this year. I think we could see some declines in the first half of this year. And then we start the recovery really in the back half. Where by the end of this year, I think we're very close to that finish line where the Fed's job is done and inflation is largely in check. If they keep doing what they're doing, if they stick to the inflation fight, I think in the back half of this year, we're starting that recovery process that continues into 2024. But given the headwinds we faced early in the year, I think we end the year essentially flat. So 3,900 is our target as of right now for where we see the S&P at the end of 2023.
Okay, so then is it fair to say that you expect a market correction in the first half of the year and then a comeback towards the back half? Is that right?
Yep, that's what we're expecting. And a lot of it in the first half, the earnings revisions are coming in. Companies are acknowledging downward revisions to their earnings estimates for the year ahead. That's coming through with these Q4 reports. That being processed in the actual start of the recession, which we expect is going to be kind of early to mid part of this year. I think those are the triggers that bring some volatility between now and let's call it the end of June. And that sometime during the second half of the year, we start to see what is a sustainable recovery path for the markets that can continue into a bull market run as we move past this year. That's the expectation.
So you'd expect good things in 2024?
I think we're going to make progress. I think those fundamentals, our legs are underneath us. And if the Fed's job is done and they're in the easing process, and I don't think it's just here. You remember, we weren't the only ones that are dealing with inflation. If you go, I had calls this morning. I did an event for a group out in Latin America. I immediately did an event after that for some groups that were out in Canada. I'm talking to business owners. I'm talking to investors in these regions. They're still dealing with inflation as well. And if you go over to Europe, there's some questions on what exactly is going to happen in terms of the weather, how that's going to flow through, for example, to inflation with energy prices for Europe. Once we get through those pieces, I think that they're going to be in the recovery path second half of this year into 2024 as well. I think we're going to see a broader based recovery heading into 2024. Now, there's always the unexpected, right? There's always things that could come up that could derail that process. But I think the major headwinds will be easing at that point in time. And I do think we will likely see progress in 2024.
Are you concerned about geopolitical events with Ukraine and Russia? Russia blocking food being sent from Ukraine to the rest of the world? Possible famine?
Yeah, no, I'm not as concerned with famine. Obviously, Ukraine is a major producer with rice, with wheat. One of the reasons that, for example, Turkey got involved in trying to lead some of the negotiations between the two countries is because they are a major recipient of the exports of the food. You know, will we see some issues and will that push upward prices on some food products? Yes, I do think we are seeing some movement. Again, when our backs are against the wall, some incredible things happen from an innovative standpoint. If you dive into the data on what's happening, for example, with food production, with our ability to create fertilizers without the same nitrogen content that we had, which was a key piece that we got from Ukraine, we are adapting. I'm not expecting the geopolitical, unless Russia escalates, unless they invade Poland, and unless they, set off a nuclear weapon, which I don't think they're going to do. I also don't think China's going to invade Taiwan. I'm not expecting that we're going to see a major escalation on the geopolitical front. I'm also not expecting that we're going to see a major resolution on the geopolitical front. I think that's going to be something that's nagging throughout much of this year. And I will warn that if we get some resolution with Russia, Ukraine, and we may see some negotiations, I don't think that the energy bans or the energy restrictions on Russia are done. I think those are more now targeted towards Putin and some of the actions that he took. If they come to a signed agreement, I don't think we're going to see a full reversal of sanctions on Russia. That part of the conversation, the impact it has from a growth, from an inflation standpoint, may very well progress through this year and beyond. Again, I don't have a crystal ball to say exactly how it's going to play out, but It's particularly on the food side. I've done a lot of research in terms of who's replacing that food content, where we're getting it to, what types of food products instead of rice, instead of wheat, we're seeing substitutes and movement. And I think we will find, well, not perfect, we will see a lot of that addressed. And I do not think we're going to see a major famine issue regionally or globally.
That'd be great. All right. Do you like certain sectors in the back half of 23 and into 24? Specifically, the question is on the tech sector.
Tech, right now, my major concern on the tech side is that tech is very investment heavy. I think in the short term, we're still going to see some movement. We're still going to see some pressure on tech, on some things like communication services, a little bit. The growthier side of the equation, I think, is going to have a bit of a tougher time, at least the first half of this year. Now, they really outperformed in 2020 into 2021. Ironically, what led during that time period was companies that were losing money. If you took only the companies that were losing money, they outperformed the S&P 500 by 250, 300% over a span of 12 to 18 months, which logically, it doesn't make sense. If you look within tech, there's ways to navigate within technology. There are companies that are older, more established companies that are producing revenues, that are paying dividends. In fact, technology, the tech sector, is a strong producer of dividends for the S&P 500. The second half of this year, after we've seen some pain, I think they're going to come back into focus a little bit. But where do I expect to see the stronger performers this year? I like healthcare. I think the fundamentals there, some of the growth expectations, some of the resolution on drug approvals that were delayed for a little bit with everything that was going on with COVID and a shift in focus. And now that we have a split in Congress, we're not going to see, I think, major regulatory changes on that front. Healthcare is an area that I like. I like energy. These companies that are producing have significant free cash flow, whether that's used for dividends or share buybacks. I think we're going to see some major return of capital coming through on the energy sector. And I like some of the fundamentals on areas, for example, like financials. They're probably going to hit some pressure in the midterm because people get worried that with a recession, what if they have issues with loans? What if they have issues with bankruptcies or defaults? I would argue, and I've looked at a lot of the data, those companies are much stronger than they were before the financial crisis. They wrote down a lot of things going into COVID. It turned out their balance sheets were much stronger during that time period. They may see some turbulence from the emotional standpoint, but I think second half of this year, we'll see some movement there too. As we progress through the year, okay, because again, the timing of that is there's still some uncertainty. What exactly it looks like here versus international. Again, those are the types of conversations we'll be having with the team. As time progresses, as we get more information, as we see things play out on the employment front, on the orders front, on the debt front, we'll have some of those conversations. But right now, healthcare, financials, and energy are three of the sectors that I think are very attractive.
Okay. I got a couple more for you, and that's probably about it for the night.
Okay.
One of them is, how would you forecast the mid and the long-term investments relating to climate change?
Yeah. So when I think about the investments as they relate to climate change, there's a couple different ways you can look at it. You can look at the ESG component. What I really focus on, again, is on the energy side. I think one of the core pieces that we need to see from a climate change perspective is improved battery capabilities. I think we will see progress with solar. I think we will see progress with electric vehicles, energy generation. One of the cautions that I have at the moment is, again, I travel across a lot of the country, and there's areas that I go to. You go down to Florida, you go down to Alabama, you go down to Mississippi, and there are some areas where they're already moved over to largely solar. And because of the climate in that environment, because they have some infrastructure that's behind them, they're called gas peaker plants that allow for off-peak hour electricity generation to fill any stop gaps. They're already at that point. The cost of production on solar has come down. However, for a lot of parts of the country, we're not there yet. And some of the developments, whether that's related to geothermal, whether that's relating to wind, whether that's happening to mini reactors, which is something that's starting to see some progress. We've seen a lot of that in places like France, in places like Belgium. In the short to intermediate term, I think a lot of people are kind of barbelling the strategy and saying, look, there's the energy generation we need today. These companies are not going to go away. They're going to be producing here for the short to intermediate term. And remember, it's not just here for the United States, it's internationally. As we move towards new technologies, they typically cost more to start. And while energy, solar, for example, starts to become cost competitive, you're going to deal with places like Uganda, where the implementation for them, it's going to continue to be kind of from a fossil fuel standpoint. What we need to do is get them to cleaner fuels. We need to get them towards nat gas, away from dung, what they're doing with some of the fibers that they're doing, coal. I think we will see improvements with CO2 emissions. I think we will see improvements on the climate side. From an investment standpoint, my recommendation would be have exposure to that. It's the direction we're moving, but also have exposure to those areas that are helping us bridge the gap to get to that. There is no quick, immediate solution that can get us there, I think, overnight. And so this is a process that's underway, but is going to take some time.
Okay, last one for you. Where would you weight international stocks, especially European, with what's going on in Russia and Ukraine? Would you underweight? Would you overweight?
Yeah, so right now I'm still a little bit underweight on international, but that is starting to change. The US dollar, historically, when the dollar is strong, as it was particularly for much of last year, when the dollar is so strong, and when we have global issues, the US is the least dirty sock in the laundry. It's the most dependable. Our governmental system, the independence of things like our central banks, it really comes to the forefront. The US dollar exploded in terms of its status as a global reserve currency. That really impacted international returns in 2022. I think we're going to see some easing on that front in 2023. I think we will see some global recovery. I do think that global Europe here over the next 12 to 18 months, their valuations are lower. The exposure to the sectors that they have, they're less technology heavy. They're more industrial. They're more material based companies, which when we get through that turn process with the downturn, they tend to do well in that early part of the cycle. So we're in the process of starting to increase some of the exposure to developed Europe. In emerging markets, I like Latin America. I like the commodity producers, particularly as China potentially, progresses with reopening. The one area that I really watch out for, though, in emerging markets is China. I'm not really comfortable with how they've been doing things from a regulatory standpoint, from a governmental standpoint. You never really know when they're going to make changes. And when you think about, right, you remember when Jack Ma disappeared 2 years ago, 3 years ago? Jack Ma, the founder of the biggest company in China, mysteriously disappears, and his company doesn't know where he's at. His family doesn't know where he's at, and that makes me really nervous. If something like that were to happen with, say, Tim Cook here in the United States, there would be a massive uproar. There would be calls on what in the world is going on, the freedoms that we have, the protections that we have. Jack Ma emerges a couple months later and he says, look, I was wrong in terms of how I was running the company. I'm going to make this big donation to the People's Congress, the Communist Party of China. And then now he kind of left the country and gave control over a lot of his company stuff to the government. From a sustainability standpoint, in terms of investor returns, in terms of the ability for companies to really invest, progress, for international investment to come in, I don't like that. So emerging markets, be careful, but I do think there's going to be some opportunities on the Latin American side, in particular, the commodity producers. Over time, as I look out 5 years, 10 years, the US has two critical advantages, I think, over any other country in the world. There's two sectors. There are two things we do here that I think we do them better than anyone else. One is technology, two is financials. And that technology component, we are moving into an increasingly technologically driven world. The growth in the markets has been driven by technology. And given that we have the founders, we have math and sciences are in English. It's the universal language of math and science. We have the people that want to come here to build those companies. We have the infrastructure, we have the talent, we have the technology to progress. I think we're going to see some stronger performance from the US overall over the next 5, 10, 15 years. But a lot of the underweights that have come from just holding your positions with the lower performance out of international, it may be a time right now to just kind of even those out. They do provide some benefits, some diversification over time. There are reasons to hold them in your portfolio. And they're kind of getting primed right now for what I think is a turn where they could start to outperform.
All right, outstanding. I'm sure if we were in person, you'd probably have a large round of applause right now. So we appreciate you being with us, Andrew. I gotta believe we're gonna probably invite you back at some point. All right, for everybody else still on, I'm just gonna wrap things up. As I share my screen, you can probably see the coming events in February, March, and April. Just realize that they're out there. The next event is February 7th, again at 6 o'clock. That has to deal with Medicare. Ben Rothering will be speaking that night. Again, it'll be about another hour-long presentation with time for questions at the end. All right, we appreciate everyone joining us. I'm getting a lot of thank yous here for you tonight, Andrew. So thanks everybody for being a part of the night, and we appreciate your questions, and thanks for joining us. Have a great evening. Thanks again, Andrew.
Thank you so much for having me. Take care.
All right, very good.